Hi, I'm Michael Yardney, and I was recently rung by a journalist from one of those daily news websites, you know about those, and he asked my thoughts on what's going to be the hotspots for 2015. He wanted me to update my comments on an article I did earlier this year. Apparently the article he wrote last January on the hotspots for 2014 was one of the most popular on their website, and now coming to the tail end of the year, it seemed opportune for an update. Now, I love giving my opinions to the media, but I hate being asked about hotspots, because that's not how I work. Rather than looking for the next hotspot or the next big growth area, which a few months later is going to be proven wrong, I prefer to use a strategic approach to finding investments or properties or locations that are going to outperform the averages over the medium to long term. Now, interestingly, before I replied to the journalist, I took a look at the original article online, and I was fascinated to see some of the predictions others had made and how those suburbs, those so-called hotspots, had actually performed over the last year since they were predicted earlier this year. Now, interesting would be a good choice of word for how they performed. In fact, a generous choice of word for how some of those suburbs have underperformed. Just like most regional and mining hotspots that were in favour of a few years ago, but have left a landscape littered with investors who've lost money. Remember, people talked about Port Hedlands and Moranbah and Mandurah and Cairns and Gladstone. They didn't come off, did they? So what's going to drive our property markets next year? I think the impact of the volatility of the Australian dollar, overseas financial crises, a flood of foreign buyers, superannuation funds, and long periods of low and stable interest rates may all appear obvious if you look at them in a rear vision mirror, but what's ahead is inherently difficult to judge, perhaps impossible. However, likely positive factors for our property market next year are pretty strong. First of all, there's the momentum of the markets, especially in Sydney and Melbourne. See, our strong rising property markets creates what I call a wealth effect. Many of us are feeling wealthier as the value of our homes go up, and we want to invest again, while others, they're feeling they're missing out on the property market, so they want to get in too. The other positive factor is interest rates. They're going to likely remain low for most of next year. Thirdly, population growth is going to continue, albeit at a lower rate, but particularly in our four big capital cities. And our economy, Australia's economy, is probably going to still perform better than most Western countries, but maybe a little bit less robust than it did this year. And steady job growth is going to slowly increase consumer confidence. This combination of factors is likely to cause a continued price growth in the inner and middle ring suburbs of Melbourne, Sydney and Brisbane over the next 12 months. However, our other capital cities are likely to languish next year. Perth's catching its breath at the moment after a few strong years, and the other capitals just don't seem to have the economic strength to attract strong population growth. Similarly, I can't see a reason for regional or mining town real estate to have much capital growth either. See, there's just no influx of people moving into these regions, and there's little to strengthen their economy. And you know, investors have dropped out of those markets as well. They're not buying up. So as always, it's really going to be demographics that drive our markets. Let me explain. As Australia's economy bumbles along, I can see little wages growth over the next year or two. But I do actually see interest rates rising, probably in early 2016, and both of these factors are going to affect some suburbs more than others. What I mean by this is rising rates are likely to affect suburbs that are more interest rate sensitive, like in young first-time home areas or blue-collar areas or regional markets. On the other hand, the property values are likely to increase in our more affluent, our gentrifying, our middle ring suburbs of the major capital cities, where the people who live there, the income is less dependent upon CPI wage increases, and where rising interest rates are less likely to have an impact on their disposable incomes. So my top pick for suburbs that are going to outperform next year would be suburbs where people have high disposable incomes and are able to and prepared to pay a premium to live there. They want to live there because of the amenities there. They want to live there because of the shopping, because of the schools. I also think 2015 is going to be a really good year to clean up your house. While I see some good opportunities in the property markets, I also recognise that strategic property selection is going to be critical next year, because capital growth is not going to be as strong as it was last year. or this year, I guess, in 2014. I also see that 2015 is a window of opportunity for those with underperforming properties in their portfolio to divest themselves of their lemons, because the odds are they're going to continue to disappoint. So how do you uncover an underperforming property? I guess what you've got to do is you've got to assess it before it eats too much into your bottom line. Ask yourself the hard questions. Is this property likely to perform like I expected? Is this property likely to outperform the markets next year? If this property were on the market today, would I buy it again? And is there anything I could do to improve the property so that it could maybe generate more attractive returns on my investment? And I'd also ask, is this property likely to outperform the market averages over the next decade or more? Now, short property is a long-term investment, but occasionally the right thing to do is to cut your losses and sell up so you can buy a better property. By the way, don't wait for your local market to get better, because the gap between the value of your property, the underperforming property, and the top performers is only going to widen. However, if your property is tenanted, maybe you should consider selling it at or near the end of its lease term to widen the appeal of your property to make it attractive to both owner-occupiers and investors. So I guess the bottom line is don't look for property hotspots in 2015. Instead, look for areas that are stable, that are affluent, in capital cities where employment prospects are strong, where incomes are rising, and where locals who are going to upgrade their homes want to live, and they've got higher disposable incomes. If you want to have a bit of a chat with our team at Metropole to work out where those are in your local state, why not give us a call on 1300 20 30 30 or go to metropole.com.au. Remember, we've got no properties for sale, but we've got access to every property on the market, so we'd love to have a chat with you about how to get into the market, how to avoid making the mistakes a lot of beginning investors make, or we'd be more than happy to review your existing portfolio to see what options you've got.